Good evening. This is Tom Alexander. It is Tuesday, October 28th. This is a special stock market update that I'm doing this evening. It's about 5:30 in the evening Eastern time. I'm in Atlanta, Georgia. This is an update as we head into tomorrow, Wednesday's trade, Wednesday the 29th. We have a Fed meeting. We have an interest rate cut that seemed inevitable. I cannot imagine what this market would do if we didn't have a rate cut. So let's assume we're going to have a rate cut. Okay. Now, the indices are continuing a historic ramp, one of the most historic ramps in a short period of time that I've seen in my 40 years. This is similar to the only other time I can recall that we've seen anything like this in the SPX and NDX was back in the late 90s. So that's where we are. Now, can the market continue to go straight up? Well, it did in 1998, so maybe it will in 2025. However, there are some things to make note of here. And let's take a look at the charts. And there's some things that you just need to be aware of that I think we all need to be aware of as traders. So let's just take a look at the charts and dive into this thing. By the way, please like, subscribe, hit the notification bell, make comments, all of these things that drive traffic to my channel. I would appreciate that very much if you do that. Okay, let's look at the charts. All right, starting with the NDX from print low to print high, print low in April to print high today. We're up 57, almost 58%. We're up about 24% year over year from close to close. That's remarkable. Gap, gap, gap. This is a market that is extended in every time frame conceivable, from 1 minute to weekly, daily, monthly, etc. We all know that. Okay, no news there, right? All right, let's look at the SPX. The SPX is not too far behind. Now, the next level to the upside in either of these markets, and this is just a guess, 7,000 seems to be a number bandied about for whatever reason, just maybe because it's the next 1,000 handle, the 7,000 handle. It's about 1.5% higher from today's session close. It's quite conceivable we'll see that in the first 15 minutes after Powell cuts rates at 2 o'clock. That's conceivable. So again, anything to the upside above recent highs in any of the indices, in particular the SPX and NDX, is a complete wild ass guess. But the SPX and NDX clearly are leading the charge higher. And yes, I know why. They're 12 stocks, all that matters until that changes. Let's take a look at the Dow. The Dow is also up substantially. It's up about 12% year over year. It's up 31% off the April low to print high today. It's also been just gap. Now, again, what's above today's session high? Who knows? Now, this is where it starts to get a little bit interesting. Look where the Dow closed. The Dow closed near its opening low, near its first hour low. The SPX and NDX closed much friendlier to the upside than did the Dow. Make note of that. Okay, let's go to the Russell. Now the Russell, it didn't participate at all today, and it closed in the lower quarter of its range. It could not take out yesterday's high. However, it's up almost 47% off the April print low, and it's up from year over year close to close about 12%. But this is starting to be, we're seeing these divergences. Does it mean anything? We'll talk about that. Potentially, potentially, it's something we need to make note of. All right, that's the Russell. Let's look at the New York Composite. Same thing. New York Composite closed below yesterday's low and on its low for the day. It's been lagging for a couple of days. So the broadest of the indices that we follow is showing a lot of relative weakness. Let's look at the equal weight S&P. Similar story to the NYA. Down on the day, took out yesterday's low. Pretty wide range down day. I mean, can you imagine the world would be in a tizzy if the NDX and SPX had been down as much as the equal weight S&P today. Now, something that I've seen very few mentioned here and there. I don't talk about it much. Haven't studied Dow theory, but I do know the transport's not being able to get off the mat here at all. I just don't see how that's a healthy long-term sign for the market. Now, under Dow theory, this is a major divergence between the Dow Industrials and the transports. But just looking at it, considering what it represents, this can't be considered healthy. Now, let's look at a couple of technical pieces. I'll come back to breadth. Let's look at VIX. Okay, VIX. VIX was up today. Also, the 5-day moving average of VIX is higher now than it was at the top here. So, again, does it mean anything? I don't know, but it's something to make note of. And then let's look at breadth. Breadth is, and again, I know what you're going to say, I know what you're going to think. Of course, it doesn't matter because only 12 stocks matter, but it does matter in the long run. It's not a healthy market when you have the S&P and the SPX up as much as they are up with breadth negative 754. This is as large a divergence as I can recall with the S&P, the Dow, and the NDX all up. Also, and I mentioned this in the weekend report, the 10-day moving average of NYSE advancing issues reached an upper extreme that we have not seen since back here in July. Now, what does that mean? Is that a good thing or a bad thing? Well, it depends on the context. If you're coming off of a low like we had in April, it's a healthy thing. It's showing upside momentum. Now, as a trend begins to mature and you're months and months into a trend, something like this will often indicate a short-term compression to the upside. And quite often, you'll see at least a short-term top. Well, we had that occur back on Friday. And now 2 days later, we have breadth beginning to decline. That itself is negative. But you're coming off of this quote unquote upper extreme in breadth. Now, you can go back and look in every single significant market turn, whether it's a bull market top or it is a short-term top leading to a significant correction in a bull market, you will have divergences like we're seeing now. The problem with that is you get a lot of false signals. The problem with that is, if tomorrow, we have more sunshine, pots of gold, rainbows, unicorns, then everything goes up together and it erases all these divergences. However, it is at least important to make note of the fact that they do presently exist and they will be resolved one way or another very soon. Now, let's say everything is wonderful. Let's say the market goes straight up tomorrow and closes on its high. Well, if it does that, it's a very positive thing for the market, no doubt. And it probably indicates, because markets typically don't end on extreme upside momentum. They end when that momentum begins to wane and you have a series of lower lows, higher highs, and you have divergences like we're seeing now. That would put if everything closes up tomorrow again and we have this big huge up momentum day, everything closes on its high, what it's going to do is going to do a reset in all this divergence stuff. And it will mean, okay, regardless of any short-term blip, we're going to be higher. Okay. Now, but it also means that short-term, we are getting super, super compressed. And by the end of the week, we're likely to see some sort of a top similar to what we saw back in early October, where at a minimum we chop and we churn, we have a 1.5% retracement, and things get reset. And that's what this market has done. It has reset mostly by going sideways at times with the occasional 7-hour drop. So I think that's if we do go straight up tomorrow, all the indices participate. That's what I think we're seeing. On the other hand, if they come out, cut the rates, the market goes up straight up 1.5% and then closes on its low for the day, that could mark a short-term top of some relative significance. So tomorrow is going to be a very important day. What happens in the morning is a complete, total, absolute guess. Be careful. I will likely send out another update before the weekend. You guys enjoy your evening, and I'll speak with you again very soon.